Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, markets may be tumbling, but history shows us that with every fall come some lessons and opportunities. So, in today's episode, let's learn from Dhirendra Kumar how to navigate this storm and emerge stronger. Welcome, Dhirendra.
Thank you.
To begin with, can you please share with our viewers some strategies or some coping mechanism to navigate this storm and stay calm during such a meltdown?
One thing which will work very well for any investor, more so for new investor, because they are if some of you have been in the market for 5-7 years, then maybe you have gotten used to it. And if you haven't gotten used to it, then for those even for those investors, first is that it's very difficult if you have accidentally drifted in the market. You just came out of the greed that your neighbor was making money, your friend was making money, and you started doing without much of a plan. Then it's very difficult to cope with it if you're likely to need that money in the short run. First and foremost, if you are able to align yourself with the long-term goal and investing in equity. Second is just trying to figure out maybe for new investors who are relatively new, choosing the right vehicle. Because most of the time you look at, most people get attracted to something which is a fancy story. Here was a sectoral fund or thematic fund which was doing exceptionally well, and you bought into that. That might not be, that is a good hook for investors to come, that's a good lure, but it may not be a right way of, onboarding or getting used to it or getting started. So for those investors, starting with aggressive hybrid fund might be a more palatable way of, getting started and to benefit from that. Third is that, learning a little bit how things work, investing in a fund which is, reasonable quality and why so understanding the mechanics of it broadly, not very precisely. And fourth is that, if you're a relatively new investor, don't watch the market every day, because a new investor, one out of curiosity, you tend to, mostly investors get started with in a good market, and the market is doing well, and you feel very happy when you invested something and it has gone up very sharply, and suddenly things turn around, and then because you are a relatively new investor, you are more curious, so maybe not making sure that your long-term money, and you don't need to watch it every day. Otherwise, you run the risk of, uprooting your investment if you start watching it every day.
Okay, now being a mutual fund historian, what do historical Sensex recoveries teach us about timing the market, and why is staying invested for the long haul critical?
When I look at the big falls in the market, the big fall was way before, 86 to 88. 40% decline in those two periods, that is exactly the period before India was on the verge of bankruptcy. That is when Indian government was, mortgaging or its goal to borrow money. That is the period after which was followed by the great Indian reform of 1990. And that was coupled with, the great Indian scam of 1992. So if you look at, the convergence of this, look at 86 to 88, it went down by 40%. And then it was further, in 1990 to 91, we saw a further decline of nearly a third of the market, 35%. Worst of times, it has taken 2-3 years for it to recover, regain its previous value. And good times, 3 months, 6 months. In case of COVID, the market recovered in about 8 months. It was much steeper decline in the shortest time period. Markets have recovered and regained their previous peak in the past, in the last 45 years, within 3 to 4 years. So that's the worst case scenario. You can't really take past and, extrapolate it to future. But the sum total is, what can you do about it? Can't do much. Keep buying cheap. And for that, you need time.
All right. How can investors balance risk and opportunity during a downturn, and what role should asset allocation play here in such a scenario?
In fact, asset allocation becomes all the more, important. If you don't do asset allocation, and if you're sitting on a sizable amount which you are likely to need for consumption, a part of it you are likely to need for consumption, and all of it is invested in equity, your regret will be magnified. To reduce that, you should put some part in fixed income for the same reason. You will have the money handy when you need it, and you will not be completely exposed to the market. And even if you don't need the money, by doing this asset allocation, you will be able to buy it when the market becomes extremely cheap. So you will be able to benefit from the fall in the market, and even periodic rebalancing might help. So if you have to benefit from the downturn, you should have some, should have a preset asset allocation, whether it be 20%, 35% is your choice, even if you're a long-term investor. But don't do asset allocation if you're in early days. If you started 6 months back, maybe start with an aggressive hybrid fund that will be a steadier take. But if you're getting started and if you're sure that you don't need the money for 5 years, feel happy about it. That, okay, you're buying things when things are cheap.
All right. Well, that's all about market meltdowns and dealing with them. Now, here's a viewer's question that we'd like to take up. Jeevan Dabra asks if all funds that he's investing in are doing well, all of them are 3 to 5 star rated. How does having too many funds translate into higher expense ratio and lowering of returns?
No, it does not translate into higher expense ratio. If you have invested in a direct plan, and if you have invested in a wide array of multi-cap fund or flexi-cap fund and things like that, expenses vary depending on the size of the fund. If the fund is a 40,000 crore fund, then the expenses will be lower, because that is how the mutual fund industry is configured. The larger you get, lower you have to charge, and so that is why it gets cheaper. It is not about lowering of expense, higher expenses and lowering of return. The only disadvantage, you can have good funds and you can have more, 10 of them, 15 of them, 20 of them. The real problem is that it does not necessarily add value. What happens is that when you have 20 funds, then you end up being almost like an index. You have some good funds, you have not so good funds, and then you have a large cap fund, mid cap fund, multi cap fund. Might as well have a BSE 500. Some funds are beating the benchmark, some funds are not beating the benchmark. And overall, you are more diverse, you're a diversified portfolio, because by even one mutual fund, you are diversified because you are investing in 50 stocks. When you invest in 5 funds, there is a possibility that these 5 funds will have a 20, 30, 40, 50% overlap among them. Then you can have some exotic funds as well, some sectoral, thematic, or a small cap and things like that. As a result of which, you will have a more diverse fund. And some of them will be beating index, some of them will not be beating index. And they might be higher expense compared to an index fund because they are much cheaper.
Right.
And but that is also not the big reason why you should not have too many funds. The biggest reason why I think people should not have too many funds, because you lose interest. When you have 5% money invested in 20 funds, then when it does well, you feel happy. When it does poorly, you do nothing. That, okay, it's a very small amount of money invested there. And when you have, and you can achieve adequate diversification or meaningful diversification even with 1 fund or even with 2 fund or 5 fund. It's very important for investors to be interested or sustaining your interest, that you are reviewing your investments every year. It must be beating the index over a 3-year period, 5-year period. And if it is not doing well, you are able to take the hard decision of changing it, because you bought the fund in the first place because it was doing well. You should not continue holding it forever if it is not doing well. No, and not holding it forever means at least 2-3 years review. And that is when not having a meaningful exposure makes you disinterested.
All right. Well, hope, Jeevan, you've got your answer there. And that's all we have for you in today's episode. Keep watching the space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.